Well, okay, it's 2 p.m., so welcome to the KLR Webinar Network. Good afternoon to all of you, and good morning to our listeners out west. We have plenty of open telephone lines here at KLR, but since this is a webinar, don't call with your questions. Type them into the question block on your computer, and I will see them and try to incorporate the answers to your questions into the presentation. Someone suggested that a webinar needs theme music like a radio talk show, so we could play music while people are logging on and they would know they reached the correct webinar. I actually think this is a good possibility. Perhaps you should think about this and send me your suggestions for our theme song. My producer Ashley is probably dying right now in the control booth, realizing I'm totally out of control, but don't worry about that. Send me your suggestions for our theme music. If you are listening to this at any other time other than Thursday, October 20th, then you are listening to the recorded version, and I cannot answer your questions in real time. But if you send me an email, and my email address will be available at the end of this session, I will try to get you an answer to your question. Today we'll be talking about the financial responsibilities of nonprofit boards. My name is Frank Monti, and I am the director of the not-for-profit practice here at KLR. Being a not-for-profit organization board member is a very important job in America, as not-for-profit organizations play a very large and very important role in our society. The board is the senior management of the organization, setting the direction that the organization will go and designating policies and procedures designed to help and assure that the organization makes progress in its mission. The board is the representative of the community that the organization serves, and the board's responsibility is both to the organization's mission and those who provide the resources used to achieve that mission. Just like everything else in life, finances are critical to the performance of the not-for-profit organization, and so today we will be discussing finances. We will discuss general financial issues, financial systems, and the actual people in an organization's financial system. We will also try to provide you information to help you understand the financial condition of your not-for-profit organization, and end with discussing some board concepts for dealing with the outside world. One basic thing to understand is that a not-for-profit organization is a company essentially like any other company in America. It has revenue and expenses, and long-term stability is achieved when the revenues exceed the expenses. While unlike a for-profit business whose primary objective is to make a profit each year, the not-for-profit business has a primary objective that is something different, mainly achieving its mission. But just because the not-for-profit organization's primary mission is not making money, that does not mean that not-for-profit organizations can lose money and still survive. So first we will address some basic financial issues. There are 9 concepts that we will discuss, and these are the first 5. And these are the last 4. So these 9 items will be financial issues that the board should address. First, we will talk about financial planning. This always sounds very mysterious, and today some people even have advanced degrees in financial planning. But I remember one day asking one of my uncles when I was a small boy, and he came to the house driving his new shiny Buick with large fins and lots of chrome, how I could be financially successful like him, since I assumed that his big car was certainly a sign of financial success. He told me, spend less than you make and save and invest the rest. And that is what financial planning is. So it's really not very mysterious at all. Creating a financial plan in your personal life is difficult enough, and doing it for business may appear overwhelming. But I actually think financial planning is easier for a business because a business or a not-for-profit organization probably is a bit more structured. If you have developed a mission, then you may have developed a strategic plan designed to achieve that mission. Next, you may have identified programs and activities designed to implement the strategic plan, and you may have worked up the costs associated with operating those programs and activities. Now that you know the costs, you see if you have the resources to pay for those costs, or you design activities to attract those resources. Eventually, this becomes a financial plan, a plan to obtain resources, primarily cash, and then spend those resources on your mission-related work. When you have a sound strategic plan, and it is linked to a realistic financial plan, your potential for having an effective organization is significantly increased. So the planning process includes everything your existing and includes evaluating, your existing and potential resources. It includes being realistic in all your evaluations, recognizing the environment today, good economy, bad economy, making sure that you are spending money wisely, are your planned programs cost effective, and taking a look at all of your alternatives and selecting the most likely to be successful. This is what planning means. We do this every day in making daily decisions, what to wear, what to eat, which route to drive to work, etc. But since we do this sort of planning at the speed of light, we seldom recognize all of the elements that comprise the exercise of planning. When you are on a not-for-profit board, I think your innate planning skills will be utilized in a more deliberate process. But planning is planning, and all of you who've lived to adulthood fairly successfully should be comfortable with the fact that you really do know how to do planning. Once the planning process is complete and it is time to implement the plan, the board turns the job over to the staff. If you are on a board of a very small organization that has no staff, remember that the job of planning and the job of implementing are two different tasks, and both of them need to be done correctly for the organization to be successful. The next topic we'll cover is cash. Always an interesting topic. Everybody loves cash. Cash is not a difficult concept to grasp. We all know what it is. We recognize it when we see it, and we pretty much understand that it is critical. We all have to be able to pay our bills, and it is no different for the not-for-profit organization. If you do not have cash on hand to be able to operate for a reasonable amount of time, let's say 1 month is probably a bare minimum amount of time, then you need to have some other source of available funds in case of an emergency. Invariably, you will hear that you need to do a cash flow projection, and this sounds complicated. But let's look at a simple cash flow projection. Whether you are projecting cash flow for a week or for a year, the basic principle is the same. We start with the cash we have on hand at the beginning of the period, add in receipts, subtract disbursements, and you have left is cash at the end of the period. So you can see how a cash flow projection is an easy concept. The difficulty comes in anticipating and estimating the cash receipts and the cash disbursements. In this regard, some of the cash receipts and disbursements are easy to project and anticipate because they happen every month, such as rent and payroll. Some are subject to estimates, such as the revenue that will come in from a fundraiser. When you're making these estimates, try to estimate realistically, and if you are not sure, estimate conservatively, which means estimate revenues low and estimate expenses high. Satisfactory reserves. Our discussion of cash leads into the subject of reserves. The first idea to remove from your head is that not-for-profit organizations must spend all the money they have and not build any cash reserves. Every individual and every business needs satisfactory cash reserves for those unanticipated things that happen. Whether it is anticipated revenue that falls short or unanticipated expenses, having the financial strength to continue operations when an unanticipated problem arises so that you can have the time to adjust rationally is very important. You want to build financial reserves so that you have the time to adjust to changes in revenues or expenses and maintain as much of your program as practical. You have to realize that it takes time to plan, and financial reserves provide you with the time to plan. Organizations that do not have satisfactory financial reserves are not viewed as being financially strong. A resource provider is more likely to fund a program at a financially strong organization than at a financially weak one. So contrary to the popular myth that not-for-profit organizations should not accumulate funds, having funds set aside for a rainy day actually makes you more attractive to resource providers than running a bare-bones, break-even operation. Let's be clear what we mean by cash reserves. On a not-for-profit organization's balance sheet, when you see a line item called unrestricted net assets with a balance of a fairly large number, it is important to realize that although the reserves is part of the unrestricted net asset balance, it is almost certainly not the entire balance. As a board member, you will probably need to ask the organization's financial person how much operating reserves are available, and are they all available and represented by cash or short-term investments. If you receive a strange look to this question, don't hesitate to ask it again in a more simple form. For example, if something happened where we did not receive any cash for the next 5 or 6 weeks, would we have sufficient cash to continue to pay our expenses over that time period? Or, if an unexpected bill came in for $10,000, could we pay it? Now that I have hopefully convinced you of the need to have satisfactory reserves, how, you might ask, does one go about getting such a reserve? The best way is to spend less than you take in for a period of time and save the rest. Alternatively, you could engage in fundraising campaign and solicit donations to your reserve fund. However, my experience has shown that such a fundraising campaign is usually not very popular with donors, and it's a difficult sell to resource providers. So my suggestion is to commit to spending less than you take in for a period of 5 to 10 years until you have accumulated cash reserves that amount to approximately 35 to 40% of 1 year's expenses. If your annual expenses are $1 million, your targeted reserve balance is going to be $350,000 to $400,000. I assume that those figures may be surprising to some of you, but satisfactory reserves is good financial management. You may be inclined to think that a good not-for-profit organization spends every available dollar on the mission today, but that would be wrong. A good not-for-profit organization spends as much as possible on the mission today while taking steps to make sure the organization is available to address its mission tomorrow. I have a question that says, this is my first webinar. My computer speaker is on. However, the site speaker is marked muted. How do I turn it on? Well, it's an interesting question that I don't know the answer to. Maybe Miss Ashley, my producer, will show up with the answer, and I'll type it in. So I have your question. I just don't have the answer. So the first prize of the day for stumping the presenter has already been awarded. Don't be confused by other balances on the not-for-profit organization's balance sheet, regardless of how large they may be. Restricted resources, items restricted to specific purposes, are frequently represented by cash, but these are not reserves because they are not available for any purpose. They are restricted to some specific purpose. Likewise, endowment assets are not available for emergencies. These assets belong to the endowment fund and are protected and restricted by the Uniform Prudent Management of Institutional Funds law. So just because you have millions of dollars in the bank doesn't necessarily mean you have reserves. Next, let's talk about revenues and expenses and the relationship between the two. Ideally, revenues and expenses move in the same direction. If expenses are increasing, probably due to inflation, then revenues also have to be increasing. If this is not happening, disaster is certainly something in the future. For some reason, organizations hate to take actions that are aimed at changing their revenue stream, even though expenses are continually increasing. For example, if membership dues are part of your revenue stream, increasing membership dues 2% a year to keep pace with inflation may be more successful than raising membership dues by 10% every 5 years. Not to mention the fact that you have a revenue expense mismatch in between increases. Realize that expenses are related to specific programs and that these programs may have specific revenue sources related to them. A general principle should be that your not-for-profit organization does not take on programs that cannot at a minimum break even, meaning pay for themselves. Sometimes resource providers like the state may offer you $500,000 in funding for a new or expanded program, but after careful analysis of the contract requirements, you believe the program will cost in excess of $500,000. Rather than accepting the contract as is, you should endeavor to negotiate with the state or the resource provider to a higher price. The more confident you are in your ability to estimate the cost of a program in advance, the more confidence you will have in renegotiating and potentially rejecting these funding sources. All expenses should be analyzed so that you know what drives them, what activities cause the expense to increase, and by how much. I think one of the biggest difficulties I experience with my clients is that when somebody offers them a contract, especially one that's fairly large, more than $500,000, they're inclined to accept that contract because $500,000 seems like a lot of money. And then when they get into trying to perform up to the contract specification, they realize that they've taken on more responsibility and more obligation than they're getting paid for. And trying to renegotiate that contract after you have accepted it is much more difficult than threatening to not take on the contract because the resource provider is not providing you with enough money. Meeting the budget, certainly a critical ingredient for success. Although the not-for-profit organization exists because of its mission, being able to address the mission is possible only because the organization is living within its budget. During the planning process, a budget was developed. Tracking actual results against this budget is critical. If your actual results are varying from the budget, adjustments may have to be made. But if you do not know you are varying from the budget, I guarantee that no adjustments will be made. When comparing actual results to the budget, I believe that all variances should be investigated, and the results of this investigation will tell you whether changes have to be made immediately and what those changes might be. For example, if fundraising revenue from a special event is significantly below what was budgeted, the questions you need to ask are we going to make up that revenue? Do we have some other activity plan that will help us make up that revenue? Or do we need to cut back where we thought we were going to spend that revenue? An expense, another example is when an expense is much greater than anticipated. When that happens, and you see that because you've compared budget to actual, the questions you want to ask are we going to try to raise more money, or are we going to try to cut other expenses to make up for this expense that exceeded budget? One of the things I always say to clients is that you don't run out of money in the 9th, 10th, or 11th, or 12th month of the year. Frequently, the problem on why you've run out of money in the 4th quarter of the year is because of a budget to actual variance that occurred much earlier in the year. But because some of your funding came in long before you needed to spend it, you don't see that deficit showing up in your checking account. So comparing the budget to actual on a regular basis, starting with the first month of the year, is very important. Now, what do we mean when we say that the board should be concerned with the propriety of expenditures? Propriety means the state or quality of conforming to conventionally accepted standards of behavior or morals. The board should be concerned that the organization is spending funds in a proper manner, within accepted standards of behavior for a not-for-profit organization. Therefore, a staff retreat in Las Vegas may not be appropriate for a not-for-profit organization, regardless of how important it was for the organization to have a staff retreat and make the organization better. There is no prohibition, for example, against not-for-profit organizations providing company cars to employees who are required to travel extensively for the organization, but perhaps those vehicles should not be BMWs. If the organization is engaged in an activity that might garner some negative publicity, but the board feels that the cost is justified, it may be worthwhile to craft a response to the as yet unasked question in advance so that one is not caught off guard. Even obtaining the assistance of a public relations professional may be worthwhile. Someone has asked if the PowerPoint slides will be available after the webinar. Yes, they will. After the webinar, we'll send all of you an email so that you can come to the appropriate part of the KLR website and get a copy of the PowerPoint slides, and you'll be able to also re-listen to the webinar if you want to, or pass it on to board members or somebody else. So thank you for the questions. Compensation is one area that consistently comes into the public's discussion of not-for-profit organizations. There have even been people in newspaper editorials that have suggested that there may be a ceiling on compensation at not-for-profit organizations. And I don't want to tell you what numbers they have suggested is a ceiling for not-for-profit compensation, but it is pretty low. You should be aware that there are very specific procedures that the board should undertake when setting the compensation for the organization's CEO. Executive compensation is part of the insider activities that are covered by the IRS Intermediate Sanctions Regulations. At KLR, we have a client information bulletin that will be available on the KLR website after this session that contains the information you need to know to perform and document the proper procedures in regard to these transactions. The bulletin is titled Insider Activities, and as I say, we'll send you a email after the session telling you how to find these on the KLR website. In terms of understanding how a not-for-profit organization should be spending its money, let's take a look at what one of the charity watchdog groups says on this subject. The Better Business Bureau Wise Giving Alliance is one such group that has published guidelines, and each of the charity watchdog groups are fairly close to these guidelines, so we tend to quote the Better Business Bureau. Now, in terms of total expenditures, the Better Business Bureau says a minimum of 65% of those expenditures should be directed to program activities. This means that general and administrative and fundraising expenditures should not make up more than 35% of an organization's expenses. The United Way has a 75% threshold for the agencies to which it routinely provides funding. So it is saying that G&A plus fundraising expenses should not exceed 25% of the organization's total expenses. When an organization provides financial data in its annual 990 filed with the IRS, which is also available to everyone on the internet, it is very easy to determine what percentage of its expenses are spent on program and G&A, or program versus G&A and fundraising. The second spending test is related to the cost of fundraising. The Better Business Bureau Wise Giving Alliance indicates that an organization should not spend more than 35 cents to raise $1 of donation revenue. If an organization is spending 35 cents to raise $1, we say its fundraising efficiency is 65%. Again, because the amount of contributions received is a prominent figure reported on Form 990, comparing this to the total amount of fundraising expense reported quickly provides the general public with the fundraising efficiency of the organization. Now, I understand that there may be reasons for spending more than 35 cents to raise a dollar. If so, the organization should anticipate this question and formulate their response in advance of the question being asked. For example, an organization may be gearing up for a capital campaign and spending in anticipation of launching the campaign in the following year. If this is the reason why your organization's fundraising efficiency is lower than the industry threshold, do not passively just report this on your 990. Rather, take some steps to explain this before the question is asked. Schedule O of the Form 990 provides opportunity for a not-for-profit organization to say anything that it wants to. So if you realize that your Form 990 has information in it which could be interpreted negatively, try to guard against that happening by putting something on Schedule O explaining the situation in advance. Insurance, a fact of life. No matter how many controls and safeguards you build into the operations of your organization, the difficulties and risks inherent in human activity due to basic human nature means that problems may still arise. One way to manage these risks is with insurance. For example, everyone handling cash should be bonded. Request your insurance agent to speak to you about a fidelity bond covering certain employees. You may be surprised how inexpensive this basic coverage is. What a fidelity bond means is that if someone misappropriates funds, you will be immediately reimbursed by the insurance agent or by the insurance company, and then the insurance company will deal with that employee. So if you come into work someday and find out that someone has misappropriated $50,000, you'll get your $50,000 back immediately. And presumably, that's important to you. If your auditors have a good deal of experience within the not-for-profit sector, they can probably provide you with an assessment of your insurance coverage versus what they see at other similar organizations. But your goal should be not to have uninsured risks. One of the unique aspects of not-for-profit organizations is that the person served is usually different from the person providing the funding. This sets up the situation where not-for-profit organizations must pay particular attention to the resource providers as well as dedicating themselves to the organization's mission. If resource providers provide funding that is restricted to a specific purpose, those resources must be spent entirely for that specified restricted purpose. You can't use those funds to pay the auditors. That was a joke. But actually, you can't use those funds for anything but the specified restricted purpose. Your record-keeping system should be sophisticated enough to be able to clearly document that these restricted resources were used for their intended purpose. Now remember, these kinds of restricted resources can come from anywhere. One has to read the contracts, the grant agreements, the transmittal letters, etc., very carefully to determine if the resources are restricted in any way. If there is any doubt, seek clarification from the resource provider before you accept these resources. Conflicts of interest. Just the name tells you there's something to be avoided here. The challenge, however, is identifying transactions with a potential conflict before they arise. Therefore, boards should have a conflict of interest policy that clearly describes what constitutes a real or potential conflict of interest with the goal of raising the consciousness of board members. If a transaction occurs in which there is a conflict of interest and the party with the conflict realized an inappropriate financial gain, both that party and the organization might be subject to fines and financial penalties from the IRS under the IRS's private inurement regulations. Now, just because we should be concerned with conflicts of interest does not mean that the organizations are prohibited from conducting business with people or companies that are close to them. It does not mean that these potentially conflicting situations should be avoided at all cost. It does mean that potentially conflicting situations should be identified and evaluated according to the approved IRS procedures and documented prior to entering into the transaction. And how you go about doing this is contained in that client information bulletin I told you about earlier. Another aspect of conflicts of interest is where a board member is involved with a competing organization or business. There is probably no way around having a board member who is also a board member at a competing not-for-profit organization. Now, the first thing to realize is that not-for-profit organizations do in fact compete with each other. This is something that many board members don't like to believe. They like to think that somehow the not-for-profit world is different from the for-profit world, but the reality is that not-for-profit organizations are competing with resource providers, whether that resource provider is the state or a foundation. And if you have a board member who's also a board member of an organization that is probably competing for resources, that's probably not a good idea. So for example, an organization like the not-for-profit YMCA should probably not have a board member who owns a local health club because they're both competing for the same people. Now we will move our discussion into systems that protect the financial integrity of the not-for-profit organization. During this session, we will talk about internal controls, accounting policies and procedures, and external audits. First up is internal controls. Internal controls are policies and procedures designed to protect the organization's asset and to promote efficient operations. The foundation of almost all internal controls is a segregation of duties. For example, the individual who approves a payment should be different from the person who acts upon that approval and writes the check, signs the check, and mails it out. Now, this is not a seminar on internal controls, so we are not going to go off on a tangent on specific controls. However, what is important is that the internal control procedures that have been established must be written down so that employees have a place to turn in order to find out the proper procedure for handling transactions. Without documentation, I can almost assure you that procedures designed for control will break down over time and eventually be completely eliminated. Internal control procedures are probably not the easiest way of accomplishing certain tasks. And human nature being what it is, people will gravitate towards doing things the easiest and most expeditious way. And if those ways circumvent internal controls, that's a bad thing. In addition to policies and procedures designed to provide internal control, there should also be policies and procedures relating to the functioning of the accounting process. These policies and procedures should also be in writing. Why? Because if they are not in writing, the probability that they are in use is substantially reduced. Organizations should have an accounting manual. This document tells the fiscal office personnel how to record transactions, what controls are in place, and how to monitor those controls. The second most important written policy and procedure relates to investments, assuming your organization is fortunate enough to have accumulated sufficient wealth to have invested assets. Remember, however, that investments does not just mean the multi-million-dollar endowment fund, it means any excess cash. External audits. I guess I should disclose that I have a potential conflict of interest regarding this subject. So my disclosure is out there. External audits may be required by law or by resource providers, or they may be one of the tools a board employs to exercise their fiduciary responsibility. Regardless of why an organization decides to have an independent audit of their financial statements, it is important that the board understand what an audit is and what an audit is not. An audit provides assurance that the annual financial statements are fairly stated. The audit does not provide an opinion on the organization's system of internal controls, although the auditor will report deficiencies in the system that come to his or her attention during the audit. A board should ask that the auditor come to a board or finance committee meeting to discuss the financial statements and the audit process. At such a meeting, board members should ask whatever questions they wish in order for them to gain an understanding of what work was performed and the results of that work. Of course, auditors must be independent of the organization in order for them to be effective. Now, does this mean that an organization should select a new auditor every few years? Obviously, I think this is not necessary. A true professional will maintain their independence regardless of the length of the relationship. Plus, there is likely to be a normal rotation of audit staff, which brings a fresh set of eyes to the engagement on a very regular basis. I believe that organizations should change auditors whenever they are dissatisfied. If there is no dissatisfaction, then I think it is short-sighted to believe that walking away from the in-depth understanding and knowledge of your business that is held by the senior management of the CPA firm will be in the organization's best interest. Right now, there is a white paper published by the Public Accounting Oversight Board on the subject of mandatory auditor rotation for public companies. Both public companies and obviously the audit profession do not think that mandatory auditor rotation is necessary. However, there were a lot of provisions of the Sarbanes-Oxley law that everybody thought were unnecessary, and that law passed anyway. So I'm a little concerned that the PCOAB will end up publishing this document in final form, indicating that it is a good practice to rotate auditors on a regular basis. And even though this will apply only to publicly held companies, these kinds of regulations have their way of filtering down to even the smallest not-for-profit organization. Again, I don't believe mandatory auditor rotation is necessary. You can go on the Mission Matters blog at the KLR website and see what I've already written on this subject, and come back to the Mission Matters blog as I'll try to keep you all informed of what's going on in this. But I think this will be an expensive situation if the not-for-profit world believes that mandatory auditor rotation every 10 years or every 15 years is a part of the system of internal controls. So stay tuned. Let's turn next to the major financial roles in not-for-profit organizations. In this section, we will cover these 4 topics. The board, of course, has ultimate responsibility for the good financial health of the organization. This responsibility may be executed via committees or task forces, such as the Finance Committee, a Budget Task Force, an Endowment Committee, HR Task Force, etc. As the organization grows in size and complexity, additional committees may be advisable. As we discussed in our webinar last month, not every committee member needs to be a board member. Recruiting non-board members onto committees is an excellent way to obtain specific talent without expanding the size of the board, and is an excellent way of getting to know people before you ask them to join a board. In addition, it is much easier to ask and get a positive response from someone when you're asking them to volunteer for a committee on which they have specific expertise. So if you're asking a banker to volunteer to be on your finance committee, the person believes they can be useful and helpful right away, whereas they may not know that much about your mission, and asking them to be on the board they feel is a bit intimidating because they don't understand the business in which your organization operates. But once on the finance committee for a few years, they will learn about the organization, and if you find that person to be a good committee member, they will probably be a good board member, and that's how you can find people to be on the board, and you get to know them ahead of time. So any of the turkeys who are on committees, you never asked to be on the board. The board treasurer is the direct link between the fiscal office and the board. Depending on the size of the organization, the board treasurer may have very specific duties to perform on a monthly basis, or his or her role may be one of simply overseeing and reporting back to the board. One of the specific duties that I think belongs to the board treasurer is approving the executive director's expense report. There is nobody in the organization that is independent enough to approve the executive director's expense report. The CFO works for the executive director. So the executive director's expense report should be approved by a member of the board. Now, this does not mean that the expense report has to be approved before we reimburse the executive director. Excuse me. We just need to be able to have the opportunity of reviewing that expense report and providing feedback to the executive director if they're doing things that are inappropriate. So, for example, if you find the executive director taking me, the auditor, out to the Capitol Grill for lunch, and lunch is $90, you may want to say to the executive director, I think this is a little lavish way to have a meeting with the auditor at the Capitol Grill for lunch. You will reimburse that once, and presumably the executive director won't take me to the Capitol Grill for lunch again. So that's why we want to have, and one of the things that we check for in all of our audits is, are the expense reports of the executive director being reviewed by the board treasurer. The CEO is also completely responsible for the fiscal health of the organization, and boards should make sure that the CEO understands this and does not abdicate this responsibility to the CFO and the board treasurer. So although your CEO will presumably be a very mission-oriented person, the CEO does have primary responsibility for every aspect of the organization, including finances. The fiscal office reports to the CEO, and this individual has the basic responsibility for the financial records of the organization. Now, the day-to-day accounting functions are performed by bookkeepers, clerks, and they may be supervised by controllers or finance directors. If an organization is very small, they may only have a bookkeeper. It is important to understand that the role of controller and CFO still needs to be performed, and the challenge to an organization that is of a size that has only a bookkeeper is to find a way to accomplish these controller and CFO type functions. In some organizations where that I have as clients, where we have only a bookkeeper, we actually have a document that contains the duties of the treasurer every month. So the treasurer goes into the organization one day a month, probably for a couple of hours, and determines if the bank reconciliations have been completed, determines if the accounting records have been closed at the end of the month and the appropriate people have signed off on adjusting entries and things like that. You can probably work with your auditor on what duties the treasurer should be doing if you don't have a large organization that has a controller, finance director, or chief financial officer. Understanding the financial condition of the organization. As a board member, your area of expertise may not be finance, so what are you supposed to do? An excellent question. First, you should realize that there is no magic to good financial health. No one can spend more money than they take in, not even the President of the United States. If you haven't had to declare personal bankruptcy, then you probably have enough basic instincts to ask good questions about the finances of your organization. If you have declared personal bankruptcy, you probably have learned whatever you did wrong in the past and can most effectively make sure that your nonprofit organization does not make the same mistakes. The Enron collapse happened because too many people said, "I don't understand how we make money, but someone must understand it, so I'll continue doing my part." As you know, it turned out that Enron was not making money, and had enough of these people who didn't understand pushed a little harder for some basic understanding, the Enron collapse may have been averted. So whatever you do, do not make the mistake that if you don't understand something, you must be stupid. You are not stupid. If you don't understand something, push to have someone help you to understand. If they can't do that, that's a sure sign of a problem, and it's probably not a problem with you. Tools to help you understand the financial condition of the organization. Regular, internally prepared financial statements. These are more important than the annual audited financial statements. You get them faster, you get them more frequently, and these are the financial facts on which you should be basing your decisions as a board. A member of management, like the treasurer or the CFO, should explain the monthly financial statements to you in language that everyone can understand. Remember, ask questions of anything you do not understand. A board finance committee should meet with the auditors to review the audit process and the results. Whether the auditors come to a meeting of the entire board is an individual board decision. I see no problem with a board delegating the auditor relationship to the finance committee. However, if there are questions that a board member has that cannot be satisfactorily answered by the chair of the finance committee, then requesting the auditor to appear at a full board meeting should be considered. When we have this annual finance committee meeting with the board, with the auditor, one portion of the meeting, usually the end of the meeting, should be held without the presence of staff, so that an opportunity exists for a frank discussion of staff issues, if there are any. At my clients, we have the auditors meet with the finance committee before the audit and after the audit, and at each of these meetings, we ask the staff to leave. That, as I say, that's usually the last part of the meeting. And we ask the staff to leave whether there's anything on our mind or not. At the meetings before the audit, it gives the finance committee the opportunity to express any concerns they may have and things they may want us to check during the audit process that they didn't want the staff to know we were going to be checking. After the audit is complete and we have the auditor finance committee meeting, again, the staff leave, and at that point we would respond to any of the questions the finance committee asked at the meeting before the audit started. And if we have anything else to say regarding the staff, we have the opportunity to say it. What's important is we do these at every single meeting, whether we have something to say or not, so that you don't have the awkward situation that suddenly, after being the auditor for 5 years, you suddenly ask the staff to leave. Remember that the auditors work for the board, so every board member should feel free to contact the auditors directly at any time. The 990, the board should review the Form 990. As a matter of fact, there's a question on the Form 990 that specifically asks if this was done. The IRS considers the Form 990 to be the not-for-profit organization annual report, and all of the information that's contained in the 990 about transactions with related parties, compensation of officers and directors, compensation of the 5 highest compensated individuals at the organization, all of that is in the Form 990, and the IRS wants to know that every board member has reviewed the Form 990. Now, as I say, there's a question on the Form 990 that asks if this was done. The IRS says, it doesn't matter whether that question is answered yes or no, but you all know that a yes answer to that question, that the board has reviewed the 990, is better than a no answer. If all information, including financial information that is to be reviewed at a board meeting, should get to board members in sufficient time for their review prior to the meeting. I recommend to my clients that board members receive information for a board meeting prior to the weekend before the board meeting. So obviously if the board meeting is on a Monday night, they're getting the information the previous Friday. But even if a board meeting is on Thursday night, I think the board should get the material the previous Friday before that Thursday board meeting so that they have the weekend to review it. I think it's asking much to have the board get the information on Monday or Tuesday so that they only have Monday night, Tuesday night, Wednesday night to review things for a Thursday board meeting. I know that my evenings are not necessarily completely my own. They're filled with various things. And having the weekend to review things before a board meeting, I think, is important. How do you recognize financial issues? Well, here's a list of a few situations that would certainly merit concern. As you can see, it's not brain surgery. Declining revenues, increasing costs, an organization that has a private inurement issue. Someone is not devoted to the mission versus being devoted to their own personal benefit. The auditors have quit. Definitely a sign of trouble. Or is the board involved in day-to-day management of the organization? What is happening to the staff? Does the board lose confidence in the staff? These are definitely problems. There's a question of, do you think an organization should have a finance committee and a separate audit committee? Usually organizations have audit committees when they have an internal audit function, and the audit committee is the management function of that internal audit function. If an organization does not have an internal audit function, which none of my nonprofit organizations have an internal audit function, I really do not think they need a separate audit committee. Because the press has talked about audit committees, I've had organizations create audit committees. What they've done is they've taken a couple of people on the finance committee and say, okay, you represent the audit committee. To be honest with you, we're only meeting with the finance committee. The two members that make up the audit committee are on the finance committee. I think the thing to realize is that selecting the auditor is a very specific process. Renewing the auditor or reappointing the same auditor from last year is a very specific process. I think the committee, whether it's the finance committee or not, should have a meeting that says, are we satisfied with the auditors? If yes, then they should be reappointed. If no, we should look for another auditor. Just the act of actually asking that question and making it conscious versus unconscious is what I think should be happening. I don't think you need to create a separate audit committee just to do that. The finance committee is perfectly capable of sitting down once a year and evaluating the auditors and the audit process. So hopefully that answered your question. Dealing with the outside world. Not-for-profit organizations must transact business with the outside world, whether it's choosing a bank, obtaining insurance, making investments, or dealing with any other kind of outside advisor. Banks, you know, the people who used to pay us to keep our money there. Choosing a bank, well, the things I'm going to say are actually true dealing with all outside relationships. You want to deal with people and institutions that have demonstrated experience with not-for-profit organizations. Now, when you're talking to someone who's trying to get your business and you say to them, are you familiar with not-for-profit organizations? I guarantee you, you're going to get a yes answer. What you want to do is to ask those people, can you give me references for the not-for-profit organizations you deal with? How many not-for-profit organizations do you deal with? Because everybody will tell you they have experience in dealing with not-for-profit organizations. What you want to do in forming these relationships is first determine exactly what your needs are, and then select a bank which is most capable and willing to address your needs. So, in dealing with a bank, do you have other not-for-profit clients? Do you make loans to those not-for-profit clients? Because some bankers may sit back and say, well, we have not-for-profit clients. They have their money with us. Do you ever loan them money? Oh, we don't make loans to not-for-profit organizations because they have no collateral. Well, that's not the bank you want to do business with. You want a bank that understands that it's perfectly okay to make a loan to a not-for-profit organization. You may have to be a little more creative than you are when you grant a home mortgage. So the experience of the organization that you're dealing with is very important. The same thing can be said about insurance. Now, we already talked about why insurance is necessary. So once again, finding an insurance agent who has familiarity with not-for-profit organization is important. On the slide here, we have identified some of the coverages you need as a not-for-profit organization. And we have even more coverages on this, this next slide. One thing I want to point out in regard to director and officer liability insurance, make sure that your policy covers your defense costs as well as covering the judgment if you should lose. The cost of proving that you are innocent is in some respects a greater risk than the cost of a negative judgment against you. So you want to make sure that your D&O policy covers your defense cost. Let's see, we have a question here. We have a couple of questions. One going back to conflicts of interest. As an insurance broker, I think it is unwise to have a nonprofit organization ask their broker to be on the board. If there was an uncovered loss or mistake that cost the organization money, then the not-for-profit would have to sue the broker's E&O policy or be subject to a policy. Well, that's a very good question. This is especially true if a third party suffered as a result of a mistake, like employee health insurance or abuse, etc. So that may be right. You may want to avoid having your broker be on the board. We as auditors cannot be on the board of any of our organizations. It's probably, I think, a good idea. This person who asked this question, I think it's probably a good point that the people we are doing business with may not be good people for our boards. One of the things I frequently see is the investment advisor, especially when organizations had their money invested with the bank. So for 20 years ago, where people had their endowment funds at then Fleet Bank, the person from the trust department was a member of the board. Well, I think, as this last question pointed out, it's very difficult to have a discussion on the performance of the investment when the board member is the trust officer. So probably recognize that there is a conflict of interest when the people you're doing business with, especially those that you're depending on to give you advice, are also board members. And maybe we want to avoid having those people as board members. I hadn't thought about the insurance agent being on the board, but I think that's right. You don't want to have the agent be on the board, even though they're not personally going to be paying you. The insurance company that wrote the policy will be paying you, but if you got bad advice from that person, that could be a sticky situation. Health insurance is another insurance that we unfortunately have to deal with. It's rapidly becoming the largest employee-related expense in most companies. This, I think, is a great area to have a special committee or task force of qualified individuals do the legwork for you on how you can try to get your health insurance costs down. There are a great many ways of still providing very good health insurance to your employees. that and reducing your costs. Next, we'll talk about investments, and remember, even a little excess cash is a potential investment. If you have accumulated more cash than you need to operate in the immediate future, the excess should be invested in order to maximize your return on this asset. Now, the more you have, the more aggressive you can be and should be with your investment choices. But if you have an extra $10,000 and you don't think you need it for the next 6 months, you could buy a 6-month certificate of deposit and make a little more money than you're going to make in a savings account. The fact that you can only make 0.5% on a certificate of deposit doesn't mean you should leave it in your savings account where you're making 0.25%. At least being aware that you have options and trying to maximize your return, as little as that might be today, is what you should be doing. I think you should seek professional assistance from someone familiar with not-for-profit organizations again in making investments. It's absolutely essential that your investment advisor understand that you're a tax-exempt organization, because frequently investment advisors are primarily dealing with individuals and corporations that pay taxes, so their investment decisions tend to be a little skewed towards the fact that whatever income they produce is going to be taxable. The fact that income to a not-for-profit organization from investments is not taxable needs to be understood by your investment advisor, and that's why a person with nonprofit experience is important. All contracts with outsiders. You want to commit your understanding of the work required and the outcome objective to writing. So anytime you deal with an outsider, you want to have a contract or an engagement letter so that everyone understands the scope of the work and what the deliverables are. This is not just true for not-for-profit organizations, it's true for any company. Don't just have a meeting and assume that people will understand and know what's going on. And that brings us to the end of today's session. Thank you all for your attention and for your questions. If I did not address a question you may have, please email me and I'll try to assist you later on. Big thanks to Ashley, my producer. Remember, we will be sending each of you a follow-up email that provides you with information on how to access the KLR website and to obtain a copy of this presentation and the client information bulletin I mentioned earlier. Oh, and also remember to send me your suggestions for our theme music. Please name the song accurately so I can find it on iTunes, and maybe at our next webinar in November we'll have theme music. Thanks again for attending. Take care and have a great day.